Chris Verrone, head of technical and macro research at Strategas, is back at Post 9 with where he sees the market going. I mean, it was, a few weeks ago we felt like, we in the store for a 10% or more correction, and here we are. Should we be believers in this bounce back?
Yeah, I think we should, and really for a couple reasons. By, call it, third week of April, you started to see the oversold conditions come together, and, the judge of any oversold is how the market responds from that. And I think it's been very compelling since. I mean, number one, you have the VIX back to where it was pre-correction. You have credit conditions, which never deteriorated even as the market was coming in. So look at double B or even triple C spreads are on their lows. And I think maybe most importantly of the lot, financials are right back at the highs. I mean, these banks have acted great through the correction and now coming out of it. And Scott, I think when you're working through these corrective phases, you always want to be paying attention to what is the first groups making new highs coming out of this. And the banks are there. A lot of global markets already back at the highs as well. So this still looks pretty good to us.
All right. So now take all that. What's it mean for how long?
Yeah.
How long is this sustainable?
We have good seasonality basically from mid-May through about late July. The old sell in May and go away, I don't know where that came from. It doesn't work. When you look at the data historically, late May through about late July is actually one of the sweet spots of the calendar. But what I think is more important here is how the leadership might be evolving. Look where the strength is coming from. Financials, materials, rest of world. I mean, the strength in China is underappreciated. The strength in Europe is underappreciated. UK FTSE just broke out of a massive rain. So maybe we're changing what's driving it, but I would expect new highs into summer.
You would. I guess we've seen this movie before with a more broad move higher. What does that mean for the tech trade? Where there were real questions about it, but then it came back, and it came back strongly as a result of earnings.
I don't think it's quite as monolithic as it has been the last 6 or 7 months. You saw it with the Mag 7 earnings. There's been some divergence. Even Microsoft, which is not too far from the highs, on a relative basis, that's been a bit underwhelming. I mean, the strength has really come from Google. That chart continues to look fantastic. I think the rally in Apple, we ought to be a little bit careful with. We're back into some resistance here. But the bigger story, as you just said, there's a broadening re-happening here. And I think the most important part of that is these global markets trade great.
You know what's interesting, too, is that the AI story, and we've been talking about it a lot on the network in the past few days at minimum, has made what may be considered traditionally defensive areas of the market not necessarily defensive. And I'm zeroing in on utilities as I say that, which are up 1.25%, this week. Because of all of the thought about, what's going to power all these data centers and all this production of these AI chips. How are you thinking about that space and then other traditionally defensive areas?
It's a great question. The first rule in our work is we know we don't know, right? We're trying to give our best guess and play probabilities. But I'm shocked how many times I've heard that line of reasoning over the last 5 or 6 weeks, that this move in utilities is the next way to play AI. I'd be careful with narrative creep. Whenever you start to see narrative creep, it does raise an antenna for us. Perhaps utilities are working simultaneously with staples because there is a bit of a counter-cyclical streak that's running through markets here. So I would be careful about making the AI jump. If you want to play AI, buy AI stocks. I mean, NVIDIA is closer to the highs than it was a few weeks ago.
They're so crowded. I mean, it's not, and the valuations have gotten stretched, right? I mean, if you're looking for other ways to play AI, I'm not saying go out and buy every single utility name.
Yeah.
But that appears to be a legitimate angle and maybe the next angle to the AI story.
Let me propose another hypothesis. Is it possible that utilities are turning here because bond yields don't run away from us? Is it possible that utilities are suggestive that bond yields move lower? And that's where I think is the more consequential piece of information.
Yes, choice C, all the above.
Perhaps all the above.
I agree with you 100%.
I think for macro investors, the more important question is 6 months from now, is it 10-year yields at 5.25 or is it 10-year yields at 4? And I think this turn in utilities, the strength in the banks, I argue more of a likelihood of 4% 10-year yields than 5.5.